Flint West, Eye of the Storm Memo. Timestamp June 1st, 2025. Context. The U.S. economy stands on a fault line. Macro indicators remain superficially stable, but structural imbalances are mounting beneath the surface. While crowd-pleasing headlines tout low unemployment and market resilience, Flint West files this memo from within the still eye of the macro storm, where clarity cuts through chaos. The central thesis, the great crowding out, this isn't stimulus, it's capital incarceration. The Federal Reserve's balance sheet remains elevated as it absorbs government debt issuance. Money market funds now hold over $7.2 trillion, redirecting capital from the productive economy into sterile yield-chasing vehicles. Government deficits persist despite low unemployment, revealing a structural, not cyclical overreach. Private capital is being crowded out, leaving small businesses, entrepreneurs, and builders gasping for credit. Forward predictions, core outlook. Unemployment will rise and remain elevated as private sector job creation slows. Labor force participation will weaken further under structural stagnation. Government cannot absorb the slack. It's not an engine of growth. It's a cost center. Growth and productivity. GDP growth stagnates as government spending contributes no real multiplier effect. Productivity flatlines. Capital formation is frozen. Investment dries up. The illusion of growth via government spending persists, but the private sector withers underneath. Inflation would spike under this deficit load, but is being artificially suppressed as MMFs and reverse repos absorb liquidity. Inflation is now volatile, bifurcated, sticky in essentials, collapsing in risk assets. Interest rates. The Fed cannot cut without igniting inflation or losing market credibility. Long-end yields will rise. 10-year Treasury over 4.5%, 30-year over 5%. Long-term debt becomes toxic, mortgage markets freeze, and future investment shrivels. On-the-ground pressure points. Consumer credit crisis incoming. Credit card debt has ballooned to record levels. Delinquencies are rising fast, and buy now, pay later schemes are a ticking time bomb, debt disguised as spending power. Student loan repayments are resurging under a weakened labor market, hitting millennials and Gen Z hard. This is a punctured vein in the neck of GDP, a gusher of lost purchasing power in a consumer-driven economy. Banking system fragility. Rising bond yields are destroying the mark-to-market value of bank assets bought during ZIRP. More banks will quietly go underwater, setting up another wave of instability. Expect a revived or new BTFP-style facility, a stealth bailout dressed in stabilizers' clothing. Sovereign debt market fallout. Foreign sovereigns are quietly stepping back from U.S. treasuries. A catastrophic treasury auction could be imminent, triggering bond market chaos. CDS on U.S. debt will spike, offering a potential once-in-a-decade big short trade. De-dollarization and escape hatches. Gold and Bitcoin will continue to rise, slowly at first, then sharply in any crisis. The stock market will be propped up at all costs to protect retirement funds and maintain illusion of stability. The Eurozone will fast-track a CBDC to lock in capital and prevent flight during systemic stress. Big picture, early-stage Japanification of the U.S. High debt, low growth. Capital trapped in sterile financial plumbing. Markets supported for optics, real economy running on fumes. Sound familiar? The U.S. is entering a slow-motion version of Japanification. Structural deficits, negative real returns, government-directed credit, zombie institutions surviving on subsidy and yield suppression. Missing pieces, corporate sector outlook. Mega caps benefit from access to cheap debt and backdoor Fed support. SMEs get crushed, too small to backstop, too big to ignore the credit freeze. Labor shift. Expect a rise in contract gig labor and part-time employment. Immigration policy may be used to prop up employment stats without wage gains. Global spillovers. Emerging markets suffer whiplash from U.S. volatility, capital flow reversals, and rising USD funding costs. More bilateral trade agreements will bypass the dollar to reduce dependency. Closing warning. This isn't a cyclical downturn, it's a systemic reordering. And the more the government crowds out the private sector, the less air the real economy has to breathe. The bond market will be the final battleground. When trust cracks there, everything cracks with it. Buckle up. Flint West, June 1st, 2025.